So on Monday, 31st of January, the Ministry of Finance announced through an official press release that the UAE will be introducing a federal corporate income tax on business profits that will be effective for financial years starting on or after the 1st of June 2023. For many tax professionals in the region, the announcement did not come as a surprise because due to a variety of reasons, it was not so much a question if corporate income tax would be introduced in the UAE, but rather when it would be introduced. In addition to the press release, the Ministry of Finance also published extensive FAQs on its website. And in these FAQs, the Ministry of Finance has outlined some of the key features and design choices of the new CIT regime. So the goal of today's webinar is to go over some of these key features and to see how they will impact UAE businesses. What we have also done in some of our slides is highlight matters that, at least in our opinion, warrant further clarification. At the same time, we have done some reflection from our side as well. So we'll share some of our initial thoughts with you to hopefully get you a bit of a discussion going towards the end of the webinar, where we have allocated some time for Q&A as well. As a final point, before we dive into the content of our webinar, we should note that no legislation has been published yet. And in the press release, the Ministry of Finance said that it plans to issue further information on the UAE corporate income tax towards the middle of the year to help businesses get ready and be fully compliant. So businesses can expect the law and the regulations to come out somewhere around June, July, later this year. As a final note, please also note that the webinar will be recorded and will be available for viewing later on YouTube. So without further ado, let's have a look at today's agenda. So in terms of the content, we'll start off by talking about the reason and the objectives for introducing corporate income tax in the UAE. Then we'll talk a bit about the scope of this new tax. In other words, which entities will be subject to corporate income tax, which is also referred to as a personal scope, and also which income will be subject to tax, which is the material scope of the new tax. Then from there on out, what we've done is we've structured the content according to how you would generally complete corporate income tax return. So first, we will go over what constitutes taxable income and which income is exempt. From there, we are going to make some adjustments for tax purposes, and these adjustments are generally referred to as deductible expenses. Tax losses as well can be taken into account to determine the adjusted income for tax purposes. We'll also provide you with an overview of the different tax rates and how those will apply to businesses in UAE. Then to close off this section, we will discuss foreign tax credits and how those will likely apply in the Emirates. And in the second part of our webinar, we'll talk about the authorities involved with the administration and enforcement of the new corporate income tax. And we'll also share some of our observations, our initial thoughts, let's say, on a number of matters. After which we'll discuss the elements or topics that, in our view, warrant further clarification or guidance at this stage. Keeping in mind, of course, that the legislation will likely contain a lot of the finer details in terms of how certain matters will be implemented. Then towards the end of our webinar, we'll talk about the road ahead for UAE businesses. So we'll discuss which steps they should take to prepare for the implementation of corporate income tax. And then finally, as I mentioned, we've foreseen a little bit of time for Q&A towards the end. No doubt many of you have interesting questions for us. So hopefully we can get a bit of a discussion going. So let's start off with why corporate income tax was introduced in UAE. But before we do that, let's have a look at the definition of corporate income tax. I'm sure many of you already know, or at least have a good idea of what a corporate income tax is. So if you look at the definition that is shown here, there are basically three elements that you can distinguish. First of all, corporate income tax is a direct tax, which means that it's imposed on the income or the profits of a person rather than on a transaction. So it's not a transactional tax. Compare that, for example, with VAT, which is levied on the supply of goods and services. Another important difference with VAT is that corporate income tax constitutes an actual cost for businesses, whereas VAT is, at least in principle, neutral for businesses and ultimately borne by the final consumer. A second element is that corporate income tax is levied on the net income or profit of a business. So the starting point of this corporate income tax return will be the financial statements as prepared by the business. And then lastly, corporate income tax is levied on corporations and other businesses. The fact that legal persons are subject to corporate income tax is perhaps obvious, but as we will see later on, some individuals may also be subject to corporate income tax in the UAE. Most of you are perhaps aware that the UAE had already implemented a form of corporate income tax, whereas it was at the emirate level, and that was specifically for oil and gas companies and branches of foreign banks. The new corporate income tax will, however, be a federal corporate income tax and will therefore apply across all the emirates. That is also indicated by the fact that the tax will be administered by federal government bodies, namely the Ministry of Finance and the Federal Tax Authority. So why was corporate income tax introduced in the UAE? So the introduction came mainly as a response to Pillar 2 of the OECD's BEPS project. As some of you may know, back in October, the UAE, as a member of the so-called inclusive framework, signed an OECD deal in which the UAE, together with 136 other countries, agreed to impose a global minimum corporate tax rate of 15% on large multinationals. Tax experts in the region knew that the implementation of a global minimum tax would have an effect on tax-free jurisdictions such as the UAE and Bahrain. So now that the UAE has decided to implement corporate income tax, the pressure for Bahrain is only rising to take similar action. In the press release, the Ministry of Finance also stressed that the implementation of corporate income tax is an expression of the UAE's commitment to meeting international standards for tax transparency and for preventing harmful tax practices. In this respect, we want to point out that in recent years, the UAE has already taken measures in that direction, namely by implementing substance rules, which, as some of you may remember, was the main driver behind being removed from the EU blacklist. So as I mentioned, when we talk about scope, there's on the one hand, the personal scope, or which entities will be subject to corporate income tax. And on the other hand, there is the material scope, which refers to the type of income that will be subject to the tax. So this is what we'll discuss in this section. And towards the end, I will also briefly talk about the effective date of the new corporate income tax regime. So let's start off by finding out which entities will be subject to the new corporate income tax. So the FAQs, first of all, refer to UAE businesses. This refers on the one hand to mainland entities, but also to free zone entities. In this sense, the FAQs are clear in stating that free zone entities will be in scope of corporate income tax unless they do not conduct business in the UAE mainland. At the outset, however, free zone companies will be required to register for corporate income tax, and they will be required to file corporate income tax returns. In the FAQs, it's also mentioned that the application will be the same across all free zones and that there will be no difference between the regular free zones and financial free zones. Perhaps a bit peculiar, but individuals will also be subject to corporate income tax if they are undertaking a commercial, industrial, or professional activity in the UAE and they are licensed as such. So that means that freelancers and individuals that earn business income will in principle be subject to corporate income tax. And lastly, I've also mentioned here on the slide, foreign entities and individuals that conduct trade or business in the UAE and that on an ongoing and regular basis will also be subject to corporate income tax. So As we've seen in the previous slides, the new corporate income tax regime, it's not limited to corporations or legal entities. Individuals that earn business income will also be subject to corporate income tax. So when are you considered to generate business income? So first of all, as a legal entity, all your activities are considered to fall within the scope of corporate income tax. So all income generated from any type of activity could, in principle, be subject to corporate income tax. That is opposed to individuals, which are only considered a business and therefore considered to generate business income, where they hold a license or permit to carry out a commercial, industrial, or professional activity in the UAE. So there is some importance to the formal aspects of having a license or being required to obtain a license or permit. In the FAQs, the Ministry of Finance has also emphasized that the newly introduced corporate income tax regime is not a personal income tax. In other words, it will not apply to individuals and their personal income, such as salaries, dividends, capital gains, or investment returns that they receive in their personal capacity. So based on our understanding, corporate income tax will only apply to business income earned by individuals who hold or are required to hold a license or a permit. So here we have an example of an individual that receives different types of income. So first of all, as you can see, this person receives income from real estate. Let's say he rents out residential or commercial properties. And in addition to that, he has a number of personal investments. For example, those could be shareholdings from which he receives dividends or other investment returns, such as interest on bank deposits. In terms of his professional activity, he's a freelance consultant. So the question is, how will corporate income tax apply to this specific individual? So first of all, the investment in real estate held in a personal capacity should not be subject to corporate income tax, provided that the individual is not required to obtain a commercial license or permits to conduct that activity. Furthermore, individuals will not be taxed on dividends or capital gains or other income earned from owning shares or investment returns, as long as they are held in a personal capacity. In terms of the freelance consulting activity, the FAQs state that any business with business income which is earned under a commercial license or permit will in principle be in scope of corporate income tax. And therefore, any income that this individual earns from the freelance consulting activity will in principle be taxed. One important element to note here is that with respect to, for example, the leasing of commercial properties, that is an activity that is subject to VAT and for which the individual might incur a registration to register for VAT purposes, as long as he exceeds the annual registration threshold. So as it stands, a license or permit is not required to rent out real estate. So that would lead to a situation where an individual could be registered for VAT purposes, but not so much for corporate income tax purposes. Finally, in terms of who is in scope of the new corporate income tax, there is one clear exemption for businesses that are engaged in the extraction of natural resources. So for those businesses, the FAQs clearly state that they're outside the scope of the new corporate income tax regime, but that they remain subject to Emirates level taxation for oil and gas companies. So as you can see here in the table, we're differentiating between, on the one hand, upstream and downstream oil and gas. So as you can see on the left side, a company, for example, like ADNOC, which is involved in upstream oil and gas activities, that will remain subject to the Emirate level taxation, whereas a company like ENOC that is involved in refining, storage and distribution, so mid and downstream, those activities will fall under the new corporate income tax regime, with obviously different tax rates as well that are applicable. Then in terms of the material scope, so which income is generally subject to corporate income tax, the FAQ states that essentially all income from commercial, industrial, or professional activities in the UAE would be subject to the new corporate income tax. They also clarify that the real estate sector and banking operations are in principle in scope of the new corporate income tax. So businesses that are engaged in real estate management, construction, development, agency, or brokerage services will be subject to the new tax. The same with banking operations, and there the FAQs state that further details will be published in terms of how that will relate to the emirate level corporate tax that exists for branches of foreign banks today. And then finally, I've also noted here that the new corporate income tax regime will not include any withholding taxes, not on domestic nor on cross-border payments. So any outbound dividends, interest, royalties will not be subject to any withholding taxes in the UAE. And then finally, a note on the effective date. The new corporate income tax regime, it will come into effect on the 1st of June 2023. So this will be a key date for UAE businesses. That's why I've put it in red here on the slide. From a practical perspective, it simply means that corporate income tax will apply for financial years starting on or after the 1st of June 2023. So the first businesses that will have to file a corporate income tax return are the ones with a financial year ending on 31st of May. For most businesses, however, who have a normal accounting period with reference to the calendar year, the first financial year that they will be in scope is the financial year starting on the 1st of January 2024. And there we expect that the tax return will have to be filed in the first half of 2025. This means that most businesses will have, give or take, 2 years to assess the impact of the new tax on their business and to prepare internally for CIT reporting. Then taxable income. Which income will be subject to corporate income tax? As I've mentioned in the introduction, the starting point to determine the taxable income is the net profit or the income of a business, where we refer back to the financial statements as prepared by the business. And there, of course, the importance of international accounting standards is also mentioned in the FAQs by the Ministry of Finance. And then finally, from that starting point, there are a number of adjustments that we make for tax purposes. But for that, I will hand over to my colleague, Nirav, who will talk a bit more about exempt income.
Good afternoon, everyone, and thank you, Nils, for sharing the background and the detailed scope of the proposed corporate tax regime UAE just recently announced this Monday. To pick up from where you left, corporate tax is levied on the taxable profits of a business, as stated earlier. In determining the taxable profits, there are 3 key factors involved: identifying which income is exempt. Excluding such exempt income, all other business income is assumed to be subject to tax. And lastly, what costs or expenses are allowed to be deducted from the taxable income to derive the taxable profits. In this section, we will take a cursory look at different incomes which are expected to be exempt under the new corporate tax regime. For ease of reference, we have classified exempt income into 5 different categories or types. The first one being dividends and capital gains earned by a UAE business from its qualifying shareholders. This exemption is also commonly known as a participation exemption. Under this exemption, dividends and capital gains earned by a UAE business from its qualifying shareholders is exempt. However, this exemption hinges on the fact that such income is produced from a qualifying shareholding. In this respect, generally qualifying shareholding refers to having either an ownership interest of at least 5 to 10%, having a holding period of 12 to 24 months, and meeting certain other conditions. Right now, of course, all the conditions are not stipulated in the FAQs or in the press release. So we expect UAE to follow similar rules to determine the qualifying shareholdings. What this effectively means is that, I'll give an example for that. As you can see on the screen, Company X is a UAE licensed business. It holds ownership interest in Company A and Company B by way of holding equity shares. It holds 5% equity in Company A for 6 months and 20% equity for 24 months in Company B. Now, considering the general conditions that a qualifying shareholder is having more than 10% ownership interest and holding period of at least 12 months, dividends and capital gains received by Company X from Company B will be exempt. However, since Company A, the dividend and capital gains received by Company X from Company A does not meet the qualifying shareholding criteria, such income would continue to be taxable. The second category of income that is expected to be exempt from corporate tax is in line with the double tax treaties. So here this exemption applies to profits of a foreign branch of a UAE parent entity that is subject to tax in foreign jurisdiction. As you can see on screen, if the net profit of the branch A is taxed in the foreign jurisdiction, such profits will be exempt, or I should say are expected to be exempt for Company A in the UAE. However, where such income of the branch is not considered as an exempt income, that is, it is taxed in the UAE, it is expected that the UAE entity will at least be allowed a tax credit of the tax paid by the branch in the foreign territory. Generally, it may be beneficial to receive a tax credit rather than exemption, since the tax credit can be offset against local corporate taxes, which in most cases would be lower in UAE than the actual tax credit. However, we will touch upon this topic in a little more detail in the subsequent slides. Now, before we get into the intra-group exemptions that you see on screen, it is worth noting that the press release and FAQs mentions that the UAE group companies can form a tax group, also known as fiscal unity, and such group can file a single consolidated tax return for the entire group. Also worth noting here is that to form a tax group, generally the common ownership requirements ranges from 95% to 100%, and we expect UAE would also follow this criteria. Important to note here that a tax group for VAT purpose doesn't mean a tax group for corporate tax purposes. So we will see some different guidelines for corporate tax grouping. With this background, qualifying intra-group transactions will not be subject to corporate tax on meeting certain conditions in order to achieve tax neutrality. A simple example that you see on the screen is where Company B is wholly owned subsidiary of Company A, and both these entities are part of the same tax group, which is they are fiscally united. Therefore, all intra-group transactions, the income that you see and the expense, both will be disregarded to achieve tax neutrality. Now, the fourth category is the intra-group mergers and reorganizations. There are different reasons as to why a corporate group of companies might wish to pursue a corporate reorganization. Sometimes businesses may even be forced into a corporate reorganization to meet the changing regulatory requirements. In this context, it is expected that the new corporate tax regime will allow for mergers and reorganizations to be undertaken tax neutrally. This effectively means that assets or share deals will not be subject to tax in such situations. However, we expect that this would be conditional, and one of the most important tests could be continuing with a control test. However, this is still not foreseen in the FAQs or in the press release. In the example that you see on the screen, Company A and Company B, they merge together into a Company P. So in this situation, the difference between the valuation of the shares will not be taxed in the hands of Company A or in the hands of Company B, since it is a reorganization case. Taking it forward, as per the FAQs published by the Ministry of Finance, other exemptions and exclusions will be provided in due course of time. What should we anticipate in this respect? Perhaps income earned by government bodies that are sovereign in nature might be exempted. Charitable organizations receiving donations or grants may be excluded, within a limit perhaps. There might be special exemptions carved out for UAE or GCC nationals. For the time being, we need to wait to get our answers. We'll go on to the next section, which is deductible expenses. So as mentioned previously, in determining the business profits, a company would definitely claim deductions from its taxable income. In this section, we will try to decode what deductions are expected under the new tax regime. In arriving at taxable profits, a company should be entitled to deduct expenses that are wholly and exclusively incurred for the purposes of trade. So in principle, all expenses incurred for the purpose of carrying on a business should be deductible in calculating the taxable profits. Now, the best way to explain such expenses is to consider all ordinary and necessary expenses incurred by a business to earn its income. However, however, it will be interesting to see how the business use criteria is defined in the corporate tax regime. For example, rent and salaries are necessary for business, but the owner drives to office in his Lamborghini. Can such motor vehicle fit the bill? It's yet to be seen. VAT rules restrict input VAT on certain expenses that fall within the entertainment category or within the blocked expenses category. Now, it will be interesting to see if there are similar rules laid down in the corporate tax regime or not. Lastly, certain incomes will be exempt from tax, as we have already seen. So expenses related to such income would generally not be a deductible expenses. Now, taking it forward is the interest expense. Since UAE is a member of the OECD's inclusive framework, it is foreseen that it will follow the principles of interest deduction laid down in the BEPS Action 4 standard, which is limitation on interest deductions, or it is commonly also known as thin capitalization rules. Therefore, interest deduction may only be allowed up to 10 to 30% of the taxable earnings before interest, tax, depreciation, and amortization, which we generally say EBITDA. We'll take it forward. Right now, of course, the rules are not out, so it is still anticipated that this is what the UAE would follow. Now here on your screen, you can see is a list of expenses that are generally considered as tax deductible. So a few examples could be rent expenses, license fees, custom duties, and irrecoverable VAT. It is irrecoverable because VAT is generally recovered by businesses through their VAT returns, so you will not have double deduction in the income tax as well. There could be deductions for bad debts, salaries and wages. Again, for salaries and wages, whether there is a limit up to which you can claim the deductions, it is yet not clear. Plus, there could be deductions for overheads and depreciations. Also, it is important to mention here that there could be certain allowances for scientific research and development, or let's say IP development cost, which could be more than the actual expenses which the business has incurred. But again, we need to wait and watch out for these kind of rules. Now, what may not be deductible under the proposed income tax or corporate tax regime? So one of the first things would be, of course, the taxes that you pay under the corporate tax regime. There could be charitable donations which an organization or a business could make, and that could also not be deductible, but it could be within certain limits. There could be fines and penalties, certain expenses which are entertainment or personal in nature, of course. There could be royalties, management fees, or any other fees which are not at arm's length priced. This is also one of the things that businesses should watch out for. There could be congresses or excursions and similar entertainment related activities. Again, it should not be a deductible expense, and that is what we expect. We go on to the next section, which is tax losses. Now let us quickly look at what is considered as tax losses. So tax losses take the color of eligible tax deduction on meeting certain conditions. So in this regard, it is important to first understand what is a tax loss. So the FAQs published by the ministry states that a tax loss would arise when the total deductions that a company claims are greater than the taxable income. Hence, to begin with, a tax loss can only be computed in the first tax year and not before the implementation of the corporate income tax in the UAE. We might see in the transitional rules certain conditions which are stipulated around losses which are brought forward before the implementation date. UAE is inclined to follow the generous loss utilization rules, wherein losses are expected to be carried forward either indefinitely or at least for 5 years, and they can be offset against future taxable incomes, subject to meeting certain conditions, of course. Previously, we also spoke about fiscal unity. So losses incurred within by one of the members of the tax group can be offset against the taxable income of another member of the group. There are, of course, certain conditions that must be met to avail the group relief. One such condition could be having a minimum ownership requirement, let's say of 75 to 100%. Again, this is not provided in the law or in the FAQs right now, and we expect that UAE would be somewhere in this range. VAT group is again not equal to a tax group, as I mentioned previously. Group loss utilization rules are also expected to be stipulated by the UAE MOF, so we should be looking out for that as well. Now that we understand that there is going to be taxable income, there is a certain income which is not taxed, there are some deductions which are available, and finally we will have the taxable income, or you can say the taxable profits on which VAT tax will be applied, the corporate tax will be applied. So this will be in UAE, corporate tax being a federal tax, it will across throughout all Emirates. The headline rate is 9%. However, UAE has adopted a 3-tier structure under which taxable income up to 375,000 AED is taxed at 0%. Now here it is important to note that this AED 375,000 taxable income is not equal to the one that is used or generally understood for VAT purposes in UAE. Again, when we say taxable income, as per the FAQs, it generally suggests that this is business profits, which is of course adjusted after the taxable deductibles. The next point is that the taxable income, which is above 375,000 AED, is taxed at 9%, which is the second rate. This is where most of the businesses would fall. And lastly, there is a carve out which is given for MNE group companies. Again, what is an MNE group company? Companies which have consolidated global revenues of more than 750 million euros, or roughly 3.15 billion AED, would fall within the category of an MNE group. And here, these kind of companies would see a different tax rate being applied on their income, which is about 375,000. Right now, we do not know what is the different tax rate, but considering that UAE is already in agreement with the Pillar 2, it should come to an effective tax rate of 15%. This is what we accept. Besides, we suggest watching out for a scenario where UAE decides, let's say, to impose a top-up tax on UAE headquartered MNEs, whose income is not taxed in a foreign tax jurisdiction. Now on the next screen here, you will see a pictorial illustration. So here on the screen, you can see there is 375, up to 375,000, there is going to be nil taxes. Above 375,000, all the income is going to be taxed at 9%, and then of course MNE groups should watch out because there is going to be a different tax rates for them. Now taking it forward, again there is tax credits which is foreseen in the corporate tax regime. So we'll go on the next slide. So the ministry has highlighted in its FAQs that foreign corporate tax paid by companies on its UAE taxable income will be allowed as a tax credit against the UAE tax liability. Internationally, the principles of credit may be applied by two main methods. One could be the full credit, which simply means that UAE allows the full credit of tax paid as a deduction against the UAE tax liability. Or the second method could be the ordinary credit, wherein foreign taxes which is paid is allowed by the UAE only to the extent of the UAE taxes. Again, it is yet to be seen which method will be adopted by the UAE. I'll hand it over now to Thomas to continue further. Thomas.
Thank you very much, Nirav, and good afternoon to everyone. Thank you for being with us. I can see that there's already a large number of questions which we will be handling at the end of the session today, all of us together. Thank you for being with us. It's some exciting times, and the parts that I'm going to talk about relate on the one hand to the administration, but also we're going to make a number of observations in regards to the applicable tax regime in the UAE, and a number of outstanding issues and matters to be followed up on, specifically when the law will be published probably around the summer, and the executive regulations as well later on. So just looking at administration as a first point, so the Federal Tax Authority, which is competent to look after VAT, excise tax, but also economic substance regulations, will also be looking after corporate income tax upon the introduction. It does so in cooperation with the Ministry of Finance, that is the competent authority vis-a-vis the foreign ministries of finance to exchange information in regards to taxpayers. That relationship also will take up a new dynamic where today, in regards to exchange of information, the UAE is relatively conservative in that it sends information usually, but it does not receive. Now, as from the 1st of June 2023, when corporate income tax will be introduced in the UAE, that will take on a new dynamic. The UAE will be interested in receiving that information. Now, moving on from enforcement by the FTA and into registration and ongoing compliance. So there is a number of details already available in regards to this. As Niels was saying, free zone companies, regardless of the fact that they might have exempt income, they will need to register and file a corporate income tax return nonetheless. So that is information which is going to be available for the Federal Tax Authority. In regards to the filing of the CIT return, obviously the format is not available just yet. There's still time for the FTA to develop that, but we know that there's going to be one tax return per financial period. So 2014, for example, being your first year subject to corporate income tax, you'll be filing roughly 4 to 6 months after the end of that financial period. So that might be somewhere mid-2025. That may seem far away. The return will be filed electronically. Contrary to other jurisdictions, there's going to be no provisional filings or advance payments neither for this return. So it seems to be with a focus on a relatively simple and straightforward return. However, in regards to what that return is going to be looking like, as Nirav was saying, we're going to have essentially 3 tiers, and if you add free zone companies exempt income to that, we're going to have a 4th tier. So that return may end up being a bit more complex than we think. So moving on from registration and ongoing compliance, where perhaps an important point is as well is currently we don't have any mandatory TP filing, but as part of the introduction of corporate income tax, the UAE has already stated that it will adhere to OECD standards, and that means country by country reporting for businesses in scope, but also master file and filing of master files and local files, or keeping those documents and having to hand them over to the tax authority upon request, but very likely subject to certain thresholds as well. Now, obviously, non-compliance is always important. The Ministry of Finance has already stated that it will be imposing penalties. Those will range from violations such as not filing the return, late filing the return, late paying, the more traditional ones, and obviously non-compliance in regards to too high deductions, under-reporting of income. Now, the Federal Tax Procedures Law and the penalties framework associated with it currently are focused on VAT and excise tax. We may see some changes in that if the Federal Tax Procedures Law will also be applicable for corporate income tax purposes. Now, moving on from non-compliance to perhaps a number of our observations that we've been making so far. Obviously, the announcement came on the 31st of January. Today, we're the 3rd of February. We had the time to sleep on it a few nights, but much will still be said. So our initial thoughts on the matter is 9% is a low rate. It's a competitive rate internationally. and it is the lowest tax rate in the Middle East for countries that have corporate income tax. One of those countries missing on the map currently is the Kingdom of Bahrain, but there is no doubt that the Kingdom of Bahrain will be considering, to say the least, a fiscal reform as well. So 9% is a good rate, is a good default rate. As Nirav was pointing out, though, under Pillar 2, the so-called other rates might lead to the application of an effective tax rate per jurisdiction, including the UAE, of 15%, which is obviously higher, but which is limited to businesses which fall inside the scope of Pillar 2, which are businesses with a global consolidated turnover in excess of 750 million euros. Now, some of our other thoughts on this is, one is the UAE is a destination country and is for foreign direct investment. It will continue to be so, given the fact that also from a tax perspective, it has made sure that it is an attractive regime from an FDI point of view. What are elements that drive that attractiveness? One of them is, for example, to not have any withholding taxes. Mills had already pointed it out, but it's very important to repeat. On dividends, interests, and royalties paid from the UAE, there is no withholding tax. Now, for inbound dividends and for capital gains, provided that you meet the conditions, those will be constituting exempt income. So this means, from a foreign direct investment point of view, a very attractive regime, a very attractive jurisdiction as well to set up holding companies. In addition, also, what the UAE has said is that it will not be taxing capital gains for foreign investors. So if you look at specifically what constitutes an attractive holding company jurisdiction, and many businesses have set up holding companies in the UAE to then invest further into the region. Very often the destination for these holding companies is one of the two federal financial free zones in the UAE, such as ADGM and DIFC. What makes those jurisdictions, or it makes the UAE attractive for holding companies, is a very large treaty network, in that the UAE is the regional champion and is definitely one of the leaders also globally. As said, no taxation of capital gains, an exemption for dividends received, the so-called participation exemption that Nirav was suggesting, a low corporate tax rate for the income which is in scope, said it already, 9% for business profits in excess of 375,000 dirhams, but also, and importantly, foreign tax credits. For example, for businesses dealing with Saudi and being taxed at the source, this may be a very important development, because those withholding taxes, they may be creditable against taxable profit in the UAE. And importantly, also, the UAE will not be implementing CFC rules or controlled foreign corporation rules. At least nothing in the press release and in the FAQ so far points in that direction. Some perhaps flip side of the coin, is it all positive? Obviously, the fact that the UAE becomes no longer a relatively completely tax-free jurisdiction, there are certain things which are perhaps a bit less positive, and we expect there to be thin cap rules. Nirav was already suggesting it. Those would be compliant with OECD standards, and will have a interest deduction limitation of up to between 10 to 30% of the EBITDA. The fact that we will have mandatory transfer pricing documentation as well, and especially around transfer pricing rules, there's going to be a lot of work in regards to intercompany transactions between the UAE and abroad. That may entail certain structural changes inside the group, and maybe challenge certain fees which are charged from the UAE, or certain income which is currently recorded for accounting purposes in the UAE, and which is perhaps should accrue to another jurisdiction. Other thoughts and issues is, Nirav touched upon the concept of fiscal unity, or a tax group, a different concept than VAT grouping. given the fact that the MOF has said that it will be honoring tax exemptions, tax holidays, provided that the regulatory requirements are met and that free zone company is not conducting business with the mainland, is it going to be possible for us to group a mainland company and a free zone company, for example, in the same way as it is for VAT purposes? And if we have such an intergroup transaction, and maybe it should be taxable when it goes from mainland to free zone, but not vice versa, shall we continue to treat it in the same way? I think those are very important questions. Another observation that some of you might have already picked up upon as well is the FAQs in the press release refer to the inclusive framework and the OECD in general and Pillar 2, but they don't refer back to Pillar 1, which may mean that in terms of the implementation of Pillar 1, which is only for businesses with a consolidated global turnover in excess of 20 billion, that those businesses will be subject to the normal statutory rate of 9%. Or it may mean that the UAE simply does not wish to tax those businesses under Pillar 1. So that's another element which remains to be seen and for which we need to be on the lookout this summer for the law and the ensuing executive regulations, and no doubt a lot of guidance still to come. When comparing the regime in the UAE with other regional systems, such as, for example, the one in Qatar and in Kuwait, and to a certain extent in Saudi as well, those have dual systems where companies held by GCC nationals can benefit from not being subject to corporate income tax. So far, there is no indication that that will be the case in the UAE, but let's see what happens. Another important thing is obviously in the UAE, despite the fact that a lot of businesses were not subject to corporate income tax, there were a lot of fees that needed to be paid. Annual licensing fees, fees for hiring people, fees for firing people, deposits to be paid, registrations with certain entities, and so on. The Dubai Department of Finance, the Director General of the Dubai Department of Finance, has already said that they will be revising those fees as a result of the introduction of corporate income tax. So in other words, the UAE will be adopting a very competitive corporate income tax framework. We will be taxed at 9%. However, there's also going to be a certain balance struck by removing or reducing those fees as well. In addition to this as well, what is perhaps as well important is when Nils was talking about free zone companies benefiting from a continued tax holiday, the important thing might mean that as an effect, the free zone authorities might be stepping up oversight in regards to where free zone companies are conducting business. Are they conducting business with the mainland or not? Are they potentially overstepping the boundaries of their licenses? Now, there's some clarifications that we're hoping to get in the next few months. We still have quite a bit of time until the law gets published and the executive regulations, and ultimately what's going to be no doubt a lot of guidance and also awareness sessions conducted by the federal tax authorities. We've alluded to it already a few times, this carve out for the free zone companies. What are going to be the exact parameters for this? Let's say that you, on the off chance that you are a free zone, a company that does conduct business with the mainland, does that mean that as from the moment that you start doing business with the mainland, that you can no longer benefit from the tax exemption altogether? Or does it mean that you're going to be making a split between the revenue that you derive from mainland and the revenue that you derive from the free zone and from abroad? That could be a possible outcome in which part of your income is going to be taxable at the corporate income tax rate. Obviously, this comes with a whole range of questions, because how do I determine where my clients are established? How do I determine where my income is sourced from? Is this going to be on the basis of the address of incorporation of my client? And will the FTA object to, for example, billing a client abroad instead of a group company abroad instead of the entity locally? Probably the tax authorities will not be very kind to such a behavior. The other matter to be reviewed, and Nils alluded to it, the UAE has been adopting international standards over the last few years, amongst others with the introduction of economic substance regulations. For those of you who had hoped that the introduction of corporate income tax would completely remove the need for reporting for economic substance regulations, and I'll admit I was one of those people that was trying to hope for this. Unfortunately, that hope did not materialize. So we will continue to be having economic substance regulations, likely, in the same way that they coexist in, for example, Qatar, where they apply for free zone companies and companies that benefit from a tax holiday, whereas they do not apply for businesses that pay corporate income tax. What else is going to be important? How is the UAE going to be determining what constitutes a permanent establishment? Are they going to have wide definitions? Are they going to have narrow definitions? Here, what may be important is when you deal with formerly two jurisdictions that do not levy corporate income tax, such as the UAE and, for example, BVI and Caymans. If I've got entities in BVI and Caymans which are effectively managed in the UAE, then it's highly likely that that's going to constitute a permanent establishment of a BVI or Cayman legal entity. Associated with those questions come, how much profit am I going to be allocating to this permanent establishment? Is there going to be a force of attraction? Is it going to be, like in Saudi, partial, full, or no force of attraction? In addition to that, are we going to see transitional provisions? The question is often asked, am I going to be able to carry forward losses from before the introduction of corporate income tax to the moment where I'm going to start paying corporate income tax? The answer, according to the FAQs, is no, but we can expect other transitional provisions as well to potentially apply. For example, some of you have already asked the question, can I increase my wage as a business owner? There may be rules as part of the transitional rules or as part of the general anti-avoidance rules, which say we're going to be looking at what was reasonably the amount of salary that you were deriving from the company before the introduction of corporate income tax and compare that with what is going to come after. The Federal Tax Authority so far for VAT purposes and excise tax purposes takes conservative positions and is not very kind to any kind of avoidance or planning. We do expect it to be possible, but we do expect that this needs to be taken with the necessary caution going forward. What else is going to be TBD or to be monitored, TBM, is how is the federal corporate income tax going to relate to the Emirates-based taxation and the carve-out for extractive natural resources, whereas for branches of foreign banks, which are currently subject to Emirate-based 20% equivalent to corporate income tax, are these going to coexist or not? Is one going to be credible against the other? These are matters to be looked at. Often also, if there's branches of foreign banks, they might have branches in mainland taxable at 20%, but they might also have an activity developed in a free zone. And to the extent that they just do business in that free zone, then they will continue to benefit from the tax exemption. Now, to be on the lookout as well is so-called what we categorize as special regimes, fiscal transparency. At this point, there is no indication that there will be a form of fiscal transparency as this may exist in a lot of other countries, for example, for partnerships or for trusts or for collective investment vehicles. At this point, there is no indication that that will be the case, but I think those are really important questions to ask. And the same thing for charities and foundations. where sometimes they are subject to separate forms of taxation in other countries. We need to see what the effect is going to be in the UAE. For example, a foundation could be holding a lot of family assets, and those family assets could be commercial buildings, and the foundation might be licensed to rent out those commercial assets. Then it's going to be subject to corporate income tax as well, according to our current reading of the information available so far. Now, what do I need to do in the coming time? What would constitute a roadmap? We'll leave that in front of you to have a look at and to ponder. I don't want to run through every single step of such a roadmap. Is there time? I think the answer is yes. Are we in a position to start reviewing structures, to start conducting tax planning? I think we are. And for every future structure that is going to be implemented right now, we need to ask ourselves the question, what is going to be the impact from a corporate income tax point of view? Because obviously business plans are made not just today for the next year, but they are made for the next 3 to 5 years. So a roadmap, essentially, the different steps that that you will see in front of you when we move on to the next slide. When it gives you a high-level idea of what it could look like. However, this is really typical or specific to every single company. We've done workshops in the last few weeks already in regards to Pillar 1 and Pillar 2. We've identified sometimes that the accounting is insufficient to file a corporate income tax return. That's something that we can look at right now. We've identified sometimes that a lot of fees are being charged from the UAE to abroad. That could be management fees or royalties that are received in the UAE. In a few years, so very, very soon, those are going to be looked at more closely because these need to be charged at arm's length. So I think there's some work to do. Luckily, we do have some time, but I think it is indeed important to already start thinking about it, reflecting about it right now before the actual law comes, because without any doubt at that point, all of us are going to be very busy, and maybe we'll have other more operational issues to reflect on. That's the main part of our presentation. You can see our details in front of you and the speakers in front of you. I can see that we've got none less than 44 questions. What I propose is that we, in the next few minutes, we together with yourself, we try and address some of those. We will try as good as we can to address as many as possible within the time constraints that we have. But let's say that we can always get back to you. And obviously, as Niels was saying, it's relatively early days, and we expect a lot of guidance to still come out. But obviously, the message is clear from the Ministry of Finance, which is, why would you announce it now? Much in advance, for example, what they did for VAT and excise tax, it is because there's a fair amount of preparation involved in this. So I think, go ahead, you wanted to take one over?
I just saw an interesting question from Iman, maybe you want to take that. So the question is, how is it going to impact, on the one hand, large multinationals that are set up in a free zone? So we know on one hand that under certain conditions, free zone companies will be able to benefit from the tax holiday. But on the other hand, there's also Pillar 2. So how do you think that's going to play out?
So I think the answer is that it might not matter whether the UAE is going to take that revenue and tax it in the UAE, because under the design of Pillar 2, whether it's taxed in the UAE and reaches an effective tax rate of 15%, or in the country of the parent, regardless, you're going to get to the same effects. And so there, indeed, it's a very important question as to the application of corporate income tax on on free zones or on free zone companies, there may be an additional dimension to that whole setup.
I see another interesting question from Jody. So she mentioned that her organization does not prepare audited financial statements. The question is, how is this going to impact the preparation of the corporate income tax return? I think we can expect that businesses with a certain revenue, they might be obliged to start preparing those audited financial statements just to, as part of the new corporate income tax regime. So I think that's my expectation, at least.
Yeah, fair enough. However, for organizations that would be fiscally transparent, there may be some leeway in that you wouldn't have to do it. Yeah. We will continue to take on a few questions.
There's another interesting question from Zair. He asked, is there any impact of the exemption for withholding tax under the treaty on interest paid by Saudi company, presumably to the UAE head office? So in that regard, I think just want to clarify, if it's a Saudi entity paying interest to the UAE head office, first of all, that's going to be subject to Saudi withholding tax. So the fact that there's an exemption of withholding tax in the UAE would not necessarily impact that. What would change under the new corporate income tax regime is that potentially you'll be able to credit that withholding tax against your UAE corporate income tax liability.
Next one, you guys want to select another one?
So one question we get a lot is, really a lot of clients have asked us, what if we just increase the salary of the business owner to then reduce the sort of taxable income, and thereby we would fall under the nil bracket, essentially, so under the 375,000. Do you have any thoughts about that, Thomas?
Yeah, I think the general anti-avoidance rules will probably address that. I think to the extent that you would see now a very large increase in that, I don't think that's going to pass. Taking out more dividends or less dividends also doesn't change anything, because dividends are paid out after tax. So, but yeah, I expect there's going to be more of these types of questions to come.
I see another interesting question here from Hamza on the free zones and the application of the tax holiday. So the question is, what constitutes a supply in mainland, right? For example, if you have a clinic in Dubai Healthcare City and it's serving patients in Healthcare City, which is a free zone in Dubai. I think internally we've also discussed this. So from a VAT perspective, we know that there are rules that say, okay, which transactions, which supplies of goods or services are considered to be in mainland, which are in free zones or designated zones. While we were discussing, it's very difficult at this stage, I think, to assess how exactly that criterion is going to be assessed of when you do business. We know that, at least from a legal perspective, free zone companies were traditionally prohibited from dealing or conducting business in mainland. So it's going to be very interesting to see how that's going to play out, and also how that's going to affect your CIT status. So as we mentioned in the slides, are you going to be either fully outside the scope if you only conduct business outside of the UAE or inside the free zone, and fully in scope if you conduct 1 or 2 transactions with mainland? Or is it going to be a proportional application where you sort of have to split out the revenue that you generate from mainland on the one hand, and then on the other hand, any revenue that's generated outside of the UAE or within the free zone? But for that, I think we have to wait until the law is published, because at this stage, the only thing we can do is speculate in that regard.
Yeah.
Also, just to pick up on where you left, Nils, there is one interesting question from Joey. He mentions that whether there is a difference between a fenced zone and an unfenced zone for corporate tax purposes, and I think there is none so far. In fact, both are at par. Right?
Yeah, and the FAQs, it's explicitly stated that there's going to be no difference between the let's say, regular free zones on the one hand, and then the financial free zones. We know that for VAT purposes, some free zones qualify as designated zones, which are traditionally the fenced free zones, but so far there's no indication that there would be any difference in terms of who is subject to tax.
So I've seen a few questions which is around IFRS and which is around audited statements, whether the company needs to maintain books as per IFRS, as per audited statements. If they are not maintaining right now, whether it will be required going forward. So right now the FAQs doesn't address any of these questions, but something similar like KSA does is if your turnover is beyond a particular limit, you will be required to have audited financial statements. If not, you will still be required to have the financial statements as per accounting standards, because based on the net profit as per your books, the corporate income tax liability is going to be determined in a way. So it is all connected.
Ali is asking the question as well in regards to the interest limitation for financial institutions, which is a really good question. So if you look at BEPS action 4, which drives the potential limitation of the interest deduction in the UAE, there is an exclusion indeed for financial services. So that would mean banks, insurance companies, they would indeed be not subject to the interest limitation deduction.
On that point, Savas also asked whether we think that the UAE will implement thin capitalization rules. So those are already part of what's announced in the FAQs. And for the people that don't know, thin cap rules, it essentially refers to how an entity is funded. It can either be equity funded or debt funded. And the difference between those two is that if you're more debt funded, you have more interest to pay, which would constitute a taxable expense or deductible expense rather, which lowers your taxable base. So that's why at the OECD level, there are certain limitations in terms of how much interest you can deduct, because otherwise you could essentially reduce your tax liability by being over leveraged.
Yeah. Victoria is asking a few things in regards to the staff, house allowances and end of services, end of service payments. And so we do expect those to constitute deductible expenses for corporate income tax purposes in the same way as they would constitute a deductible expense for accounting purposes as well.
Ali asks, how will the corporate tax revenue that's collected at a federal level, how will that be allocated or distributed back to the Emirates? Is that going to be similar to how it's done for VAT? I think that's an interesting question, and we were also discussing it here at Aurifer. I mean, there's nothing yet in the FAQs that indicates that there would be a redistribution. It's a federal tax, but they do sort of seem to allude that there will be more guidance on how the federal corporate income tax relates to the Emirates-based taxation, specifically for banking operations. So potentially, we might see some interesting guidance or regulations in that sense.
Yeah. In the meantime, we keep scanning some of your questions for some interesting questions. Yeah, Iman is asking the question in regards to the status of UAE companies and specifically free zone companies in regards to the application of double tax treaties. So the UAE had a bit of a special position or a special situation in regards to the application of double tax treaties because it has a very large network. However, sometimes some of the other countries or jurisdictions would hold it against the UAE companies that they are not effectively subject to tax. Now, the introduction of corporate income tax as from 2023 will indeed, let's say, at the least recalibrate some of these relations a bit. They, especially for the mainland ones. But let's say, for example, that you're a free zone company and you are subject to corporate income tax. Also, there should be no longer any question as to whether you can benefit from the double tax treaty or not. It's going to be interesting to see if the position of some of the tax authorities abroad is going to evolve as a result of the incorporation of corporate income tax. We do believe that will be the case.
There was another interesting question, and I think multiple people have sort of alluded to the same concept. The question is whether we expect that UAE head office and branches would require a separate registration. Are they considered to be part of the same, taxable person for CIT purposes? What are your thoughts on that, Thomas?
I don't know.
Yeah.
To be seen.
My expectation would be, because in the FAQs they talk on the one hand about legal entities, my expectation would be that it is one single registration for tax purposes, but like you said, we'll have to see and await the final legislation.
Moving on, in regards to some people who are asking questions about bad debts and provisions, we do think that if you're making a provision, that the tax deductibility is going to be subject to certain conditions, and that might be, for example, for bad debts, a certification from a third party, or writing off, or contacting your clients and saying that you're writing it off, and provisions obviously to the extent that they would be tax deductible, but that they would be reversed, and that would constitute taxable income as well. Someone is asking CBCR and its impact on corporate tax. There's no direct impact apart from the fact that CBCR is an information tool for tax authorities. And so what you're reporting for the UAE as from 2023 or as from 2024, depending on when your financial year starts, under tax paid and tax payable in the CBCR report, you're going to have to start filling in the numbers. And the expectation is simply that the UAE is going to start using those CBCR reports as well, in order to ensure that there's effective taxation in the UAE as well, when it considers that there's potentially avoidance in relation to the UAE.
There is an interesting one. If an entity is part of the MNE group with consolidated revenue exceeding the threshold, however, the entity's taxable income is less than 375,000 dirhams. Sarim asked whether this will continue to be exempt, or that is taxed at 0%, or will it be taxed at the differential rate?
Sorry, I was reading the other question, so feel free to answer this one, Nida.
I think in this regard, it is something which the guidance should specify, but right now it is not clear, because if the income is less than 375,000, then effectively it should be taxed at 0%.
So we've been taking questions for 18 minutes already now. We'll maybe just see if there's one or two more. So Vikash is asking why the tax rate is 9% and not 15%. So it's a good question now. The 15% corporate income tax, effective tax rate under Pillar 2 is only an obligation to implement as an inclusive framework member for businesses in scope. That means consolidated global turnover in excess of 750 million euros. So the UAE is free from a tax policy point of view for businesses that are below that threshold to simply apply whatever statutory rate it wishes, in the same way as Ireland has a dual or a two-tier system currently, with 12.5% being the statutory rate and 15% being the effective tax rate for businesses in scope.
There's another question here from Carl. He said they recently signed over the shares of their local sponsor, so they're now 100% fully foreign owned. Question is, if there's any exception for Emirati business owner, would it potentially be beneficial to re-involve the local sponsor in the business? As we mentioned in one of our initial thoughts about the new regulations, there's seemingly no exclusion for Emirati-owned businesses. So at this stage, I wouldn't re-add the sponsor immediately. Let's wait for the final regulation to be published.
Sure. So I propose that we close off. There were many questions, 71 questions. Feel free to drop us an email. You've got our contact details in front of yourselves. We're going to be making these slides available on our YouTube channel, so I encourage you to like and subscribe our the video on YouTube. Please also do follow us on LinkedIn. We're very active, publishing daily updates in regards to taxation in the GCC, and do not forget also to subscribe to our newsletter, which distributes on a monthly basis all relevant tax news in the GCC. Thank you very much to Nils and Nirav for presenting today. Thank you to everyone for attending as well. We hope to see you soon, and I'm sure that we'll be discussing quite a lot of these matters in the next few days going forward. Thank you very much and have a good day.